front running the market, the time to buy is now. Why is time to buy now? Now, a lot of people look at the market and they can only see today, 6 months from now, and they can still see the interest rate at 6.5% to 7%. And that makes you scared. I totally understand. I was an investor. I am still an investor. I understand. I deal and work with everyday investors today, switching from residential to commercial, and understand the fear of being in the negative territory. And I understand the fear of leveraging up to 100% when you're buying a property, which means you're taking equity from your residential property and you're putting it into commercial property. Now, what I'm going to share with you in this video is how the time to buy is now and why you should buy now, and what does your picture look like in the next 1 to 2 years. Right? And also, this is the type of property you should be investing in to position yourself to get the gains in the next 2 to 3 years, especially in the next 12 to 24 months. So, my name is Helen Tarrant, and I help everyday Australians transition from residential to commercial, and I help them build out a successful commercial property portfolio that gives them cash flow, growth, and uplift. If you're interested in that, tune in and I'll share with you an opportunity for you to join our community later on, or book a free strategy call so that you can get involved and start investing in commercial property. So let's get started. So why do you need to front run the market? What exactly is front running the market? It is getting in before other people get in. And why is that important? It is because if you get in before other people get in, then you are going to make more gains than other people. If you buy what other people buy in this market, so for example, everyone wants to go to Perth right now for their residential properties, or in fact for any kind of investment, because it's the hot topic, right? If you go to Perth now, you will be following everyone else, except you're 12 to 18 months behind. You probably should have gone to Perth 18 months ago when there was a trickling of people going to Perth and the property prices were still 30 to 40% lower than now, right now. Now, if you go to Perth in 6 months time or 12 months time, you would have missed it, pay top of the market, and when the market falls, you're going to make the biggest losses, right? So that's why following the trends isn't going to work, right? The same thing applies in commercial property. How does that apply? If you front run the market, you get better returns, you buy at a lower price, which means that you get more cash flow and you need less money in the deal, right? But it all allows you in the next 12 to 18 months, as more and more people come into the market, because other people aren't watching the video like you are now, they're not reading books, they're not participating, they're not active. What they're doing is they're going to follow the trends. As the trends all about coming into commercial property in the next 12 or 18 months, when the interest rate drops and people are seeing cash flow, what that's going to do is more and more people are going to come in, supply and demand comes in, your property is going to be worth more, your rent's going to go up, you're going to have more cash flow in your pocket, you can refinance using that cash flow, and you can buy again. That means that if you front run the market, so get in before other people do, you could actually reap better rewards and better benefits than everyone else. Now, I know we've got a housing crisis. I know everyone's trying to get into your own homes. And we are seeing the last, between 2020 and 2023, property prices have gone up on average 20 to 30%, some areas 40%. So it's become unaffordable. So the switch has been to consider commercial property. Now, if you are getting into commercial property, the fundamental reasons that you're getting in is so that you want to be having cash flow, right? But unfortunately, with the Reserve Bank, what they've done is they've taken all the cash out of the system. So that means that we're paying more for our properties, we're paying more for electricity, we're paying more for our maintenance in terms of getting new parts for any of the things we need around the house, we're paying more for building, and we're generally paying more for staff and wages because of the broken supply chain and not enough people coming to Australia. How you can solve this problem is actually investing savvily and smartly, and actually aligning yourself with a group like Unikorn Commercial Property, or following myself, Helen Tarrant, on either Insta, podcast, on this YouTube. So if you haven't subscribed, make sure you subscribe and hit the bell, but so that you're getting more information about the market, right? So going back to front running the market, let's say, for example, right now, if you really need cash flow, most people are going to go and chase that cash flow in regional. And that's regional is going to sit somewhere between 6.75 to about 7.25. So about that yield point, right? And that's in large regional towns. That's towns like your Waggers, your Albury-Wodongas, like your Rockies and your Townsvilles, your Mackays, maybe your Gympie's, maybe down in Warrnambool. These are the properties all around Australia, regional, Victoria, New South Wales and Queensland, that have those kind of returns. Now, when you get in there and the interest rate right now for a commercial property, not residential, commercial property, is 6.75%, you are breaking even or making about $2,500 per million. How do we calculate that? Let's say that you are buying $1 million property and you're taking out a portion of your loan from a redraw of your equity. So you're redrawing down your equity. That equity sits there about let's say you might have redrawn down 150 or 200 or 300,000, and let's say you leveraged it between anywhere from 65 to 80%. So let's say you could buy $1 million property. The residential loan side of getting that equity out, that cost is probably around 6.5%. Now in the commercial space, it's probably sitting somewhere around 6.75% or 6.5%, depending on how you finance it. So when we calculate 6.75 across as an average of that $1 million, it costs you $67,500 to hold that property, i.e. 6.75% across the $1 million. Now, if you're getting a net rent, so after all outgoings before mortgage, of 6.75% yield, it's $67,500. So if you're paying $67,500 in your interest and you're getting $67,500 in your rent, you are neutral and breaking even. Now, of course, with any purchase, you've got to put in some costs. We didn't calculate the cost in this scenario. I'm just using the $1 million as an example. And you shouldn't be calculating cost, because that cost actually, you get it back, part of that cost, either through tax deductions or as a cost against your future capital gains. So that's a different story. We'll cover that in a different video. But if you go to regional and you get a 7% yielding property, you're actually gaining. You're getting $2,500 more for that property. Pure cash flow after paying 100% of your interest, all of your outgoings, you're getting $2,500. Now that might seem really good, and you think this is a great way for me to front run the market, but wrong. That's not how you front run the market. That's actually just purely chasing cash flow and looking at it from a yield perspective. Now, if you want to front run the market and really gain in 2024, now this is the big key, is that you need to buy regional, add a lower yield. I'm not talking 5.5%, I'm talking about 6% in a metro area, because what you want to do is you want to have capitalized on the effect of the influx of investors in the next 12 to 18 months. Now, if we look at some articles here, right, we have seen that there's predictions on just the 9 News that we might have up to 6 rate cuts, which might bring our basis point down by 0.75% or maybe even up to 1% in terms of our interest rate. So where we're sitting at 6.75, we could be at 5.75 in a year's time. And they're thinking that with this article in the AFR, in the Australian Financial Review, that these rate cuts could mean that in 2024, that we could, at the end of 2024, we could be somewhere around the high 5s. In 2025, we could be somewhere around the 5, right? What does that mean for you is if you buy 6% yielding property and it's 100% financed, right? Your interest on those is still $67,500, but your net rent you're getting back is $60,000. Now you're going to be negative $7,500. You're like, well, why would I want to be negative $7,500? Well, that negativity of $7,500 actually rules out a lot of purchases. You would not believe how many purchasers won't invest because they're negative $7,500. Now, this is the fundamental thing between residential and commercial. And if you're struggling to get into the property market, and if you get into a residential and you find that buying $1 million property, you find it really hard to service $20,000, $30,000 in debt, you will find it easier to service a $7,500 negative versus a $20,000 to $30,000, right? Especially instead of trying to buy your own home, potentially buying an investment property and letting that property grow a bit, letting the market do its thing to have, so you front run the market, then you can pull out that money and buy your residential property, right? So this is a different way of doing it, a different way of thinking, right? And that's what I help investors to do, to transition from residential to commercial. This is what Unikorn's commercial property specialize in, but also we specialize in helping you build a portfolio out, whether you're buying $500, $1 million, $2 million property or $5 million property, and moving that up the scale so that you can invest more and more, ultimately owning a shopping center of $8 or $10 million, right? Now, if that is of interest to you, click the link below, book in for an obligation-free strategy session where we can personalize the commercial property strategy for you. Now, let's go back to front running the market. If you have bought a property and you're negative $7,500, let's look at what this AFR review has said. You're going to be, December 24, you are going to be looking at potentially interest rate of high 5s, right? So now, remember you're getting $60,000 from this property. Remember the interest rate's at 6.75. That's going to drop. So if you buy the next 6 to 9 months, you're not negative $7,500 because that's on a yearly basis. You're probably only negative $3.5 to $5. So it's about $100 a week. And most of us can afford $100 a week to get the growth in the back end, right? So then, as the market changes and the interest rate drops, you're going to find that you're actually neutral, or if it drops below 6% in the interest rate, you're actually positive. right? You're positive, and you're getting even more positive when you have the next rental increase. Where the next rental increase in commercial typically is 3 to 4%. That's going to add about $2,000 to $2,500 to your bottom line on a 6% yielding property. So that means that you will actually start making money within 6 months and 9 months of getting into this property. You'll be positive. And then going forward, you'll be positive in year 2 as well. As we can see, as interest rate drops more, you have your rental increases, you're going to have more cash flow. But when the interest rate drops, one of the interesting things that happens is that everyone else comes back into the market. When everyone else comes back into the market, it creates a boom, right? And what creates booms and busts is people coming into the market and leaving the market. We're seeing this happening in areas of Perth. We're seeing this happening in regional areas, like smaller community regional areas, right? And the reason we're seeing that is because we're seeing people going in there over a space of 2 years, then realizing that it's hit its peak, becoming too expensive, looking back and going, hey, I could do better, I get better deals in other areas, leaving that area, and the property market drops because it's got nothing to sustain the market on its own without those influx of purchases. So you're looking for areas that doesn't get influenced by that. It goes up, but it has underlying factors that support it. And that's metro areas of Brisbane, Melbourne, Sydney, Gold Coast, Sunshine Coast. You might find it in Newcastle, in Wollongong, you might find it in Geelong, areas like that, right? You might find it somewhere near Toowoomba, the Ipswich area, towards maybe your Noosas, not quite into your Gympie's, right? So those areas, right? So those metro areas that are supported by a lot of other infrastructure. So what does that mean for you? If you bought in at a mil, in 18 months time as the interest rate goes down, that property could be worth 1.2 million, could have grown by 20%. At the same time, you're picking up anywhere from $2,500 to about $5,000 to $7,000 in positive cash flow. So if you're thinking that it's too expensive for you to get into the property game in the residential space, then the commercial space is for you, because you've got to front run the market. How do you front run the market and actually be able to get enough information and data to make sure you're picking the right places, looking at the right spots? Means that you need to join a community, have people behind you to support you, and be able to show you the ways of where the market is going, how to pinpoint it, how to do that research. So one of the things that I do for our community is I have actually one of the largest communities in Australia of commercial property investors, over 10,000 people on my database that I help people every day to transact in the commercial property space. You can join that community for as little as $67 a month. As part of that community, you get our meetups, you get our webinars, and you get some guidance on where you should go. But on top of that, you get regular updates as well about the market and investor stories. So all you have to do is find out more, click the link below, and there is a simple way of just joining us in this community. You can trial it for a month and see if you like it. There's no obligation to continue on, but the most important thing is that you join a community, help to learn and find out what is the next step for you in your investment journey, whether it's residential or commercial. But remember, just because you can't buy residential doesn't mean you can't start with commercial. So until next time, keep hunting, keep looking, and don't forget to build out your plan.